Good morning, ladies and gentlemen. Well, very little to say new after a week in which we had minimal movement in bonds and in equities. Some things are staring under the surface, so I'll take this opportunity to run you through the model score and the individual components so you can better navigate and have a look for yourself what is happening. Well, the model closed very much unchanged on the week, and you can see that if you hover over it, you get a video explaining things. So wherever you see this hover video, you can just go click it, and it'll take you to the video explaining what is going on. I think the score started somewhere around 75 the week, and we closed at 69 with minimal risk off on Friday. The fact that the score went down a few ticks means absolutely nothing. It's still very strongly in risk on, which basically says prefer equities. But let's have a look now at what the individual components did and what they are or might be warning about. To have a look at what components might be causing trouble or might be about to cause trouble, we'll go here to spread ratios aggregate. And here in this quadrant you see what is basically not great. And the fact that a lot of technology spreads are beginning to be in this quadrant is slightly worrying, which basically says keep on looking at the technology sector for things that might go wrong. Now that is hardly surprising, right? Because let's face it, we've had a huge run up in technology, which has dragged everything else up. And therefore, if there is going to be trouble, it should be intuitive that it comes from the technology sector. But that is confirmation of what I've been telling you for a couple of weeks, that watch technology because not everything is right. To see how much everything is not right at the moment, we have a look at these stacked attributions of volatility. And as you can see, there is nothing really to be worried about here. You can see how these stacked volatilities rise very rapidly and warn you when there is trouble, like there was in March. And then when they start falling precipitously, like they did in mid-April, towards late April, they tell you that things are fine again. Here, we're still fine. We are in the lower part of everything that's happened since basically the end of May. And therefore, they're not really warning of anything imminent. But should they start coming up above this peak, they're telling you stuff is going on. So I'm just showing you what to look at. I know this is not grouped the best, but I will change that so you can in order of importance, as it were, so you can actually navigate it far more intuitively. Then to see not only which sectors are causing or might be about to cause some trouble, but also what kind of trouble, we go to the spread ratios individual, and we have a look at where we are in terms of spread charts. You can have all the spread charts here, and you can see that none of them at the moment are yet busting through the 50-day moving average, and that most of them are still in very clear uptrends. We can group it by commodity, and you can see really that commodity is becoming stronger day by day. USO, TLT particularly, SPY, DBC is now in a downtrend, and so on. But really, if we look at the equal weight, we can see how weak the equal weight is, which basically, again, reinforces what I said earlier, that it's all in the big stocks, isn't it? And any kind of real volatility to the downside can only happen through the big stocks. because breath is already in the toilet. And it's very unlikely that the 495 stocks which haven't participated in the rally are going to collapse and bring everything down. It has really to be at least a combination of the very strong stocks coming off as well. If we have a look at the risk off, we can see that a lot of those components are still not, either trending or coming to their Z scores and their moving averages. But the one that's most worrying is this one, and confirms basically what I've been saying for a couple of weeks. If the trend is going to change, it's going to come from technology. And a lot of these technology spreads are now beginning to roll over. They haven't rolled over, they're just beginning. If we're going to have a strong risk-off move, it will be led by these spreads. So watch these spreads and let's see if they start moving strongly to the downside, because only that way can we have the model overall fall into risk-off. If we want to see how volatility is likely to behave, or how it has behaved in the past when the score has been in the current bin, all we do is we come down here and we have a look at the multi-day return distribution by current model bin. So what it says is you read it here, the 1 day volatility, these are the 5th percentile and 95th percentile. So the most we're looking at minus 1.39 to minus 1.94. That is unlikely on Monday. But what is interesting is the 5 day, i.e. the week, is likely to be slightly more volatile than the mean. We do have the Fed, and therefore, this is hardly surprising. But here is what we will be looking for as maximum moves. Why is this useful? This is useful because it tells you what kind of 1, 2, 3 or 0 day to expiry options you should sell and not sell. It gives you an indication, a very good idea of how far the market is likely or has moved in the past, and you can make your own judgment based on that. If we start getting a very low model score, you do not want to be selling close to the at the money volatility. You want to go very far out the money, or you want to be buying at the money volatility. And this basically gives you an idea of where we are. We are now in a non-volatile state. It can change very quickly, but it basically tells you that the likelihood that we're going to have more than a 4% move next week is extremely low. Okay, so for bonds, of course, the FOMC is going to be the most important event. We hardly have anything else next week in any case. So, what do we look at? Well, we just don't look at anything but the dot plots. The dot plots are going to tell us all we need to know, and Jay Powell can talk as much as he likes, and he can put any emphasis he likes on anything he wants. This is going to be our guiding star. I doubt very much indeed that these dot plots for 2023 are going to move. So basically you can see 2023, 2024, 2025. I just wanted to enlarge this. These aren't going to move, okay? So they're not going to say, oh yes, we are done, because that removes optionality. And we saw what happened when the ECB tried to remove, or probably not tried, but removed optionality during the press conference, and then they had to walk it back the next day. I don't think the Fed is going to be that stupid. The ECB are idiots, and the Fed is slightly less. So what they're not going to do, they're going to maintain these dot plots. They're probably even going to squash them together, i.e. say one more hike is likely this year. But the interesting thing will be especially the 2024 plots, and see how far these come grouping back together as opposed to this huge 2025 spread. Now, it's very possible that some of these extremes come down and these overall come back up to something like 4.9. It's possible that, coupled with these spreads probably coming back up towards 4 as a mean, i.e. a tightening grouping, we can forget about that. That's a longer term one. That means absolutely nothing. But a tighter grouping upwards here and a tighter grouping upwards here would have a big effect on the 2-year note. So let's look at the 2-year note. And you can see that 527 has been my level since forever, and that can easily be seen why on the monthlies. And here we are. This was the high back in 06, and it's quite possible that we see it. But if we see it, and it will be a consequence of the bunching up of the spreads, you can do back of the fact packet calculations and see where the break-evens would be, and to me they would be very close to that kind of level. So it's quite possible that we get a 20 to 25 basis point move in the 2-year note next week, on Friday, and if we see 527, we put all our chips in. Can it go further? Yes, it can, but it's very, very unlikely to. Simply because the calculations I've done give me a no more negative carry around that kind of a level spread over the 2 years that are coming up. I think it's extremely unlikely that inflation is going to reaccelerate, and I think it's extremely unlikely that the Fed will want to keep Fed funds at more than a 2% real for any length of time, in which case 527 makes technical and fundamental sense to put chips in. Now, do I know if it's going to get there? No, but all I know is that if it gets there, you really want to be a buyer of 2-year notes, and only after that can the yield curve react the other way, i.e. go into steepening. If we get 527, naturally it'll flatten to that level, but once there, I think all the risk and all the reward is going to be on the steepening side. So let's have a look at the 2s 10s and then the 2s 30s. If those dot plots move like they could move, we could easily see a move back up to 85 or even 19 2s 10s, but from there all the danger is to the downside. And then 2s 30s, we could get a move to 80, maybe even 85, and then all the danger is again to the downside. If we look at the other individual tenures, this formation in 5s to me breaks higher in yield. Same for the 10s, same for the 30s. Now, if we get these bunching of the dot plots at higher for longer, as I showed you, it seems logical to me that the 2s immediately reach those levels and then they stay there, but from there on they're looking to come off in the 2s, while the 5s, 10s and 30s are still worried about the supply and they keep on going up. The 30s to me are in a pattern which will break up to higher levels, and if we have a look at a monthly chart, those levels to me are 470 in the 30s. That is the only level at which I go all in on being bullish bonds as opposed to being bearish bonds. And you can see how the yield curve is going to react. It's going to flatten first and then steepen. So those are our risk rewards for next week. And we do nothing until we see what the Fed says on the dot plots. We don't listen to the press conference. We don't do anything. We just follow the dot plots because that is the way the market is going to respond. To me, the likelihood of higher bond yields is pretty overwhelming. Really what we want to do is we want to wait and then play the yield curve once the twos are exhausted. Now, it's obvious that whatever the Fed does, it's going to have much the same kind of repercussion on the European curve, but just less so. To me, this pattern still goes towards this 289.90 level in the Bund and still goes towards this 285 level in the Bobble and still goes to 341 in the twos, in the Shats. It's just that the differentials have to come, keep on going out to me. To me, the 10s and the 30s at some stage, even though they came slightly back on Friday, this is nothing compared to the indication that you had the day before, have to eventually start breaking this 173 and going to 182 and 190, especially in the 30s. I really do think that we're going to see 173 and then 192 and possibly above in 200s. So what I'm saying is that if we get those dot plots overall that bunch up and show you a higher for longer, i.e. that the Fed thinks that rates are going to remain higher and they are not going to go a million miles from where they are now, but the path downwards is shallower than they predicted earlier, you get the reaction first in the short end, i.e. because the long end is going to like it. So the yield curve in the US first flattens, and then once it's reached the flattening levels, all the risk reward is again on the steepening. Same in Germany. First of all, you get the reaction in the Schatz and possibly the Bobble, but after that you start getting the reaction in the longer end, and these differentials start going out. I really think that by the end of the year we see this 190 in the 30s because the supply and the natural tendency of the yield curve to steepen is going to favor the German bonds over the US bonds, and I see no alternative to this trading a good 10% higher. Let's just cover the other possibility. Let's say that the Fed, for whatever reason, doesn't move its dot plots. I think in that case, the yield curve will just steepen like crazy, and I would have thought that we'd get 2s10s around the 47 area. How are we going to get there? Well, we're going to get there with the 2-year doing absolutely nothing and the 10s and 30s getting slaughtered. I really don't think that the market is going to like that, and I think they're going to sell 10s and 30s and they're going to be buying 2s. 2s are going to go nowhere after 2 or 3 days of action, and 10s are going to be higher by 10-15 basis points. So that will be the direction of travel down towards 47 if the Fed doesn't move its dot plots, or even if it moves them lower. I think the likelihood is very low, but all you can play if that happens is a steepening yield curve. I haven't changed my mind on the dollar, and I can't change my mind on the dollar until and unless I start getting bearish of the spread between Germany and the US, and I still think it goes out, and I see no alternative to going out. And therefore, just like I see those 30s going towards 200, I can see this going up towards this kind of level by year end. So I'm still bullish the Dixie, and this kind of level, 109 something, is where I sit over the course of the next couple of months. And I see absolutely no reason to change my mind because of tiny little deviations on a day-to-day basis. Nothing tells me that the euro should be strong. I think we've broken the 200-day moving average. Can we go a bit sideways and piss about? Yes, but eventually we're going back down here. We're going down towards parity. That's the way I see it. So difficult to keep on saying the same thing about gold week after week after week, but I see no alternative until I start getting bullish on bonds, and until I start getting bearish on the dollar. I just don't see any point in owning it, and I don't see any point in owning it. This is slowly turning. Can we, just like in Dixie, can we have another week of doing nothing? I think it's unlikely. I think, the Fed is going to provoke movement, and I think all the risk reward is to the downside eventually. But I'll be wrong. What can I say? I just see no reason to own gold above shorting bonds and being long of the dollar. I just can't see what's going to make it move. Here we have the commodities, and as you can see, they're definitely in a bit of an uptrend. Where do I no longer want to own them? Well, I guess at this kind of level, just around 26.10. I think that's going to be very hard to sustain, and I think then gold can come back towards 735, something like that, on a spread against DBC. But I really see no point in doing anything until oil is at these levels, around the 92, 93, and I don't think it can go any further than that in the short term. It's already done a doji on Friday. These kind of levels are very unattractive to me. The risk reward is all to the downside from there, and therefore it tells me that DBC from those kind of levels, from the very high 25s or 26, is unattractive, and you really don't want to own it. In which case, what is going to cause that? Well, it could be some Fed hawkishness or something like that. We will see. We will know what to do when we see what the Fed says and what the dot plots are. I think it's going to affect every single every single sector, including commodities. If you squint very hard, you can see the first signs of moderation. And let's bring it in some more in the rise of the Blue Angels. They've now pumped up the expectations for earnings in 2024 so much that it's hardly surprising that they can't pump them up anymore. But to me, it's obvious that equities, until and unless you start getting some real data which shows that the economy is moderating in any way, and we're just not getting it, are going to be preferred to bonds. Bonds can easily go another 20, 30 basis points up in yield, and which is a good 5%, or anything between 5 and 7%. And equities go nah, and go 2, 3, 4. They will still keep on being preferred, and that is all there is to it. So where can they go? Can they come down to times 18? Yes, of course they can. But I don't think the impetus is going to be there for anything lower than that. I think, it all depends on the big technology stocks, which should be most affected by the rise in bond yields. But unless that rise is spectacular and very quick, I think even technology is not going to have a precipitous move. So let's have a look at NQ, because NQ basically will dictate where SPY goes. There's no point in even looking at SPY now. I certainly do think that if long bonds go towards 475, or as I showed you earlier, it has to have an effect on the Nasdaq. But what kind of an effect? I mean, can it do an ABC and come down to something like, 38% retracement or even 50% retracement? I mean, this is 13,800 odd. Yes, it can, and catch the 200-day moving average and then stay there and then move back up. Absolutely possible. But I think that big moves in NQ beyond these kind of levels are terribly unlikely. I think that it might come down if the dot plots go higher, as I expect, but this 14,700 area is going to slow its fall, and then it's going to bugger around and then come back down. That's all possible. But unless the bonds start really screaming higher and reaching those yields, I think it's very unlikely that we get big moves in NQ. And if we don't get big moves in NQ, the likelihood of any kind of big move in SPY is almost excluded. The other thing that I'll be looking at next week is if IWM can come back down into 179.40. As we can see, basically it's been held here at 180, let's call it 183, just below 183, can't close below 183. If on Fed day we close below 183, I think then the likelihood is that we're going to test 179.40, bounce around a bit and then break it down, which will be the first indicator that we do have some weakening in the economy, some real weakening. But until that happens, until IWM, sort of starts saying that it wants to lead us down and bond yields aren't screaming higher, I just can't see equities still not being preferred. And an additional reason why I just can't get too bearish equities is because what Europe, did last week and keeps on doing it, i.e. holding the 200-day moving average and bouncing off it. And trading very well within the weekly Bollinger Bands. It's really not doing anything that wrong. And let's face it, this is the market that should be the weakest, right? It's the market where the real economy is weakening. So if that one doesn't give you, sell signals and weakness in trend signals, then it's very unlikely that it's going to be the States, although the States are much richer. So I'm still looking for this chart to start breaking down to give me an indication that, all equities worldwide are going down. But it's just not doing so, and I'm not going to force it. I keep on covering all shorts when it gets to these levels of the 200-day, and it hasn't been wrong so far. I've done it many times, and I've made money every single time. So until I start losing money when I start covering and buying at these levels, around the 4200 to 4220, I'm just not going to get bearish stocks. Finally wanted to show you Nikkei. It came into the top of the daily Bollingers, and basically it finished the week up. Everything else, all other markets finished the week down to unchanged, but Nikkei keeps on doing the best. And this is hardly a very bearish pattern on the weeklies, nor is it a very bearish pattern on the dailies. If next week on weakness and general disappointment with what the Fed is doing, stroke saying, all it does is come back to these kind of levels and stabilize, then it's telling you that equities as a complex everywhere internationally are not weak. If that's all it does, to me, it really has to start breaking this 31,800 level to the downside and coming down to the 200-day moving average. But even that, all it's saying is that it's not now as opposed to, oh, I'm bearish. So everything could be having a bit of weakness next week as a result of what bonds might do on the dot plots, if the dot plots are what they are. But I don't think it's the kind of weakness which leads to risk off and people wishing to abandon equities, because equities seem to be the only asset class which is not losing money hand over fist like bonds are. So until and unless that happens, and I think that the risk dial will definitely warn us when that does happen, it's unlikely that equities are going to be the biggest losers next week. I've updated all the levels, and in bonds I still think that we are likely to reach the extremes. I think the 2-year note at 427, as 527, all chips in, and of course I'll tweet to you. This is where the dot plots are. You should download them and compare them to the new ones. That's the only thing that's going to be interesting from the Fed point of view, and that will set the tone for the rest of the week. Thank you very much indeed, and tweet you tomorrow.